Moyen, and welcome everybody in this wonderful Luxembourg. We have some sun today, that is more or less usual, but we don't miss clouds. As you can see, there are here in the sky. So I would like to thank you to all of you to listen now myself and thereafter an interview with Mr. Andrea Volpi. Andrea Volpi is an economist of Intesa Sanpaolo. He is very well known, and is thanks to collaboration between the Luxembourg Financial Market Association in Luxembourg, led by Vincenzo Giunta, with the Italian Chamber of Commerce, where I'm proud to be the chairman, and with, obviously, Intesa Sanpaolo. So, Mr. Volpi will talk about what will happen in the second half of this year in Europe and in Italy, and also with a view concerning the recent election in the European Parliament. I think it would be very useful to listen, also because there will be some matters that came out from a dinner we had with Mr. Volpi and with some other key players of the financial market in Luxembourg, in Italy and in Europe. So, for all of you that are interested in economy, and I think that everybody should be interested in economy since it's moving the world, pay attention to the interview that will follow. Thank you so much, and I'm waiting you with Mr. Giunta in Luxembourg.
Welcome everyone to the new episode of Spot and Forward. Before going deeper into today's topic, let me first thank Mr. Fabio Morvilli, President of the Italian Chamber of Commerce, and Mr. Paolo Agretti, Financial Institutional Sales at Intesa Sanpaolo, for making this event happening. The trigger for today's discussion is second half of 2024, what the future holds for the macroeconomic landscape. To navigate this topic, we can leverage on the contribution of Mr. Andrea Volpi, economist at Intesa Sanpaolo. Dear Andrea, it is a pleasure to welcome you here in Luxembourg, a special venue of Intesa Sanpaolo, the European hub for the activities of the Benelux region.
Well, thank you very much, Vincenzo, and the whole LFMA. It's a real pleasure being here.
I would like to jump straight to the point and start with our first question. We are meeting just a week after the European election. What are the implications of the results? Will there be a significant shift in European politics and economic policy?
I think that if we look at the EU aggregate level, there were no big results, no big surprises in results, as they've been, I would say, broadly in line with polls and expectations. We had some losses for Liberals and Greens, but that had been widely anticipated. We also had a continuation of the rise of the far right, which, however, has been in place for quite a few years now. But if we look overall at the aggregate level and the previous majority, one made of socialists, liberals, and populars, well, at least at the aggregate level, as I was saying, it held up quite well. And I think it really was the EPP, the European Popular Party, that came out as the real winner of these elections. Not just because they did slightly better than the polls predicted, but also because if you look at the composition of the parliament in relative terms, you would notice that it would be almost impossible to make decisions without at least considering the EPP, which I think will likely maintain its role as a kingmaker of the European Parliament. What I think is a bit more surprising were national results, like in Germany, or what happened afterwards, like in France, where we will face a snap election in a few weeks. And that could also have quite a few implications at the EU level as well. And I do not necessarily think that that sort of developments reduce the likelihood of von der Leyen being re-elected as EU Commission President. Well, actually, it could be quite the opposite, as she came out stronger from this election, and in such a complex political background, I think EU leaders would consider her as a sort of safe choice and they would like to renominate her as soon as possible in order to avoid additional tensions. What I meant when I was saying that developments at the domestic level could affect EU politics is because if you look at how the decision-making and policy-making works at EU level, and since those two countries, Germany and France, have historically been the two driving forces beyond EU politics, well, we think it's fair to assume that with more political instability in Germany and a likely shift to the right in France as well, that could imply policy-wise that the EU shifts to at least marginally to the right as well. And that would imply, I think, less European integration, or at least less scope for more European integration. And also in terms of fiscal integration, we will probably see fewer steps towards more fiscal integration. And also for what concern other key policy issues, like the Green Deal as an example. Well, the Green Deal will likely be made probably less demanding, also in terms of timing to meet targets, or migration policies could also become, I think, more restrictive.
Turning to macroeconomic developments. After a few weak quarters, the Eurozone economy is finally growing again. Do you expect the recovery to continue in the coming quarters?
Well, I guess someone could argue that the stronger than expected GDP growth that we've got at the beginning of the year was due to a few one-offs, like an unexpected rebound in construction activity, like in Germany or Italy, and that could reverse already in the current quarter. And I guess you could also say that maybe the recovery is still fragile, since it's still affected by some of the previous shocks, like the energy crisis, high inflation, or previous rate hikes. However, we are starting to see some quite encouraging signs that the underlying trend of the economy is gradually improving. And that would be consistent with our baseline that GDP growth could reaccelerate starting from the second half of the year. As a matter of fact, manufacturing is indeed bottoming out, although from very low levels. But even in Germany, which so far has been the weak link of the euro area economy, well, even there, leading indicators are suggesting that the worst of the cycle could be over, maybe. And as international trade is finally picking up, we also believe that the restart of the inventory cycle, also the international level, would provide some additional support to industrial output in the second part of the year. On the top of that, if we look at domestic demand developments, we think there are still a few missing elements, which, however, we think will recover soon. A typical example is private consumption, which admittedly so far has been rather sluggish, with household sentiment still well below average. However, if you look at fundamentals, well, we think they're improving. The labor market is reasonably robust, the unemployment rate is at a record low, wage growth still quite solid, and also inflation, which I guess you could argue that is still quite sticky, well, it has been showing some positive developments over the past few months. So our idea is that that main narrative, that the recovery purchasing power will support private consumption, well, we think that narrative is still valid. So our view is that in the second half of the year, so in a few weeks probably, the joint recovery of net export and private consumption will likely underpin GDP growth. Of course, we keep seeing some element of weakness, like construction or some element in investment. But overall, we do think that they will start to stabilize by the end of this year and recover in 25. So just to give you a few numbers, well, we're currently forecasting GDP to grow by around 0.7% this year, and then a moderate acceleration to around 1.3% in 25.
You expect the recovery to continue, and you mentioned that inflationary pressures are still high. Do you think the ECB will cut rates further this year?
Well, actually, we do. Our view is that the ECB will cut rates further in the coming months, and we are currently expecting 2 25 basis point cuts, one in September and one in December this year, and then a few other cuts in the first half of 25. Of course, as the ECB emphasized, it's going to be a data-dependent process. So our baseline is also conditional on inflation showing more progress over the coming months and during the summer. And since we still believe that there are quite a few reasons to be cautious, we think that a July cut is highly unlikely, since we think that the ECB would like to wait for some more data and new and fresh forecasts in order to probably clarify some element of its baseline, which, as we think, if they will be confirmed, well, September and December would be the right time to cut rates this year. But of course, as I mentioned, since there are quite a few elements to be cautious, especially if you look at the latest wage and inflation developments, well, from that point of view, we think there are quite a few points which are worth to be made. The first one is, as you mentioned, is about the cycle. So the recovery is probably gaining momentum, but it's still fragile. And on the top of that, we do not think that the economy is overheating, as financial conditions we think are still quite tight overall. And our view is that even a couple of more cuts would not make monetary policy supportive. On the top of that, if we look at the latest inflation developments, well, yes, I understand that the May HICP print has been quite disappointing maybe, or maybe not as good as we wanted. But we're starting to see some encouraging developments even there. So price expectations, even in services, will at least stop increasing, and we think they will normalize over the coming months. And also, if you look at the data breakdown of the HICP print, you will see that, well, probably there are quite a few one-offs or extraordinary factors that could justify that unwanted rise in services inflation. That does not necessarily mean that we are facing an overeating of domestic inflationary pressures. And also, if you look at the most sticky components of services inflation, which are still showing uncomfortably high, I would say, inflation rates, well, most of them are the so-called late movers, which by definition are still affected by previous shocks, like supply chain shocks, the energy shocks. But since those shocks are easing, well, they will also normalize over the coming months. And our view is that by the time that we get to the September meeting, well, we could see some more progress toward that sort of result that the ECB is looking for. And on the top of that, I think there is still quite a relevant point, which is about wage growth. So, of course, the latest wage prints have been a bit stronger than we and the ECB expected. And wage growth is likely to remain quite robust over the course of the year as well. However, in some countries, it's already past its peak. And another thing which I think is quite important to stress is that after the loss in purchasing power that we've experienced over the past few years, some degree of wage growth is indeed needed. What we will be monitoring instead will be the relationship between wage growth, business profits, and productivity. And in the current context in which productivity dynamics are still quite unfavorable, this is where we need some balance. And that is what we think the ECB will be also watched quite closely, and that is the sort of result they are looking for in the next forecast. But however, if you look at the latest developments, at the latest deflator numbers at the beginning of the year, what you see is that actually businesses reduce profits in order to absorb higher labor costs. And that is a sort of first step in the right direction that we were looking for. And we think that that would justify a continuation of the easing path of the ECB over the coming months.
What about the Fed? Since the beginning of the year, markets have significantly downsized their expectation for rate cuts. Do you expect the Fed to start an easing process this year?
Well, to be honest, we didn't change that much our view in the Fed over the past few months, since even last year we've been repeatedly argued that markets were discounting way too many cuts. And now they're actually realigning to our original view, which is that the Fed will cut twice this year, the first time in September and the second one in December. Of course, I understand that at the latest FOMC meeting, the Fed sort of pushed back expectations for a rate cut. And in their dots plot, they're now penciling in just one move this year. But we do not necessarily interpret that as a sign of a more hawkish central bank. Maybe just a little more cautious, I guess. But to be honest, if you look at the Jay Powell conference, well, we thought that that was, I think, marginally less hawkish. And also, if you look at the details of the dots plot, you will realize that basically the committee is very much split between 1 or 2 cuts this year, which I'm simplifying here, but I think it makes the point, which means that according to the Fed, the likelihood of 1 or 2 cuts this year is almost the same. And on the top of that, the latest data developments have been quite favorable. So we are starting to see some signs that the labor market is softening, that economic growth is moderating. And the latest May CPI prints, well, it was quite encouraging, since we think it was that sort of first step in the right direction that the Fed was looking for. Of course, we wouldn't overreact to single data print, and we will be monitoring quite closely the stream of data during the summer. But if, as we think, by the way, we will get some more news that the economic growth, economic activity is indeed moderating, that the labor market is rebalancing, and that CPI growth actually stabilizes at that 0.2% on a monthly basis that we've seen in May, well, we think that that would fully justify the first cut to come in September and then a second one at the end of the year.
On that note, I would like to thank Intesa Sanpaolo and a special thanks to Andrea for enlightening us on what we can expect in the second half of the year.
Well, thank you, Vincenzo. It's been a real pleasure. Thank you.
And for those of you watching us online, stay tuned for the next episode of Spot and Forward.